Well, thank you again, Fred, and welcome to all. I'm not so sure about Fred quantitative easing, so I thought I'd bring my own liquidity. The world economy has, as forecast, been staging a moderately vigorous V-shaped recovery since about the middle of 2009, as officially recognized in the United States by the National Bureau of Economic Research. As Fred noted, however, the recovery has been quite disparate in terms of economic performance, that in particular, the world as a whole has grown about 4.5%, a little above, a little below, depending upon the results for the final 2 quarters. But emerging market countries and developing countries have been growing more strongly than anticipated, likely to turn in growth of about 6.5% on average this year, while the industrial countries have performed somewhat disappointingly relative to forecast at under 3% rather than a little over 3%. Looking ahead to 2011, the basic picture is that I think global growth will be a little bit slower on a year-over-year basis next year than this year. We can already see some evidence of that in the numbers, which suggest that growth in the second half of this year is slowing somewhat from where we were in the first half of the year. So global growth is projected to be down 3 or 4 tenths of a percentage point, with the emerging market countries turning in about 6% growth. Here, the main story is you have a surge of recovery after an extremely steep decline in trade and manufacturing production and so forth in the first year or so of recovery. In the second year, you don't get that same resurgence, so the growth rate naturally tends to be a little lower. But 6% is not poor performance. 6% is still very strong performance in the developing and emerging market countries. Among the industrial and other advanced economies, I expect growth to be about the same next year as this year, though the pattern will be a little bit different. We got strong rebounds in a few of the smaller, particularly the newer advanced economies, Korea, Taiwan, and so forth. We're going to get less of that this coming year. I think the major advanced economies will, if anything, perform a little bit better in terms of growth. Now, what I want to do this afternoon is to review briefly how I see the prospects for some of the main countries in the world economy before turning in more detail to the U.S. economy. I'll say a little bit about Europe, but Jacob is going to talk about that in more detail. And then I want to discuss another issue that relates to the global forecast and the policy issues arising therefrom, namely the question of global rebalancing in the course of the current expansion. So if we look at the forecast for this year and next, and I should note 2012, they're at least preliminary projections. I don't see 2012 very differently from 2011. We are in a global expansion. I don't see any reason to anticipate the global expansion will end anytime soon. Monetary policies, generally speaking, are supportive in the advanced economies, highly supportive of continued expansion. Fiscal policies are becoming somewhat more contractionary, but I think not enough so to pose a major threat. Emerging market countries, some of them have begun to tighten their monetary policies as inflation rates have been moved up. But again, I don't see any major threat of a dramatic slowdown there either between now and 2012. The further we go out, of course, the greater is the likelihood that something untoward will happen. But the record suggests that forecasts beyond about 18 months or 2 years are pretty well worthless. Forecast trend, it's the best you can do. So that's the story for 2012. Looking at 2011, for the emerging markets and developing countries, as I say, I see growth slowing down a bit. In China, I think we've already seen some indications of problems in the property sector and so forth, and the quarterly growth rate slowed some in the second quarter. So I think they're going to have year-over-year growth next year that's going to be a little below 9%, so off a percentage point or more from this year's likely outcome. India, I also see a little bit slower, but not much. And the rest of emerging Asia, again, modestly slower. So Asia will still be, by a substantial margin, the most rapidly growing region of the world. Latin America is actually doing quite well this year, led by an extremely strong performance from Brazil. 7.5% is the strongest growth we've seen out of Brazil in decades. I don't think that will quite hold up, but I expect another good year next year with 5% or perhaps slightly better performance. Mexico is more closely tied in to the U.S. Economy. They're lagging a little behind us, but I think they'll catch a little of the recent slowdown in their year-over-year number, recent slowdown in the U.S. in their year-over-year number for 2011. The rest of Latin America, most of them are doing quite well. Venezuela has been a disaster, but it's really the only one, at least of any significant size, that's been turning in negative numbers. And Chile was affected by the earthquake and so forth. They'll probably be a little bit stronger in 2011 than in 2010. Others will probably be a little bit weaker. Overall, Latin America should continue to do quite well. Central and Eastern Europe, despite the problems in a few countries, is recovering from the global recession. Poland, which didn't suffer in the recession, didn't suffer an output decline anyway, is doing reasonably well. Turkey has been doing reasonably well. I'm not expecting, however, substantial strengthening of growth next year, as those countries that have done quite well this year probably aren't going to do quite as well, and that will sort of make up for the fact that some that have been doing poorly will do a little better. For the Commonwealth of Independent States, one can question how independent some of them may be, but I expect growth to be reasonably well sustained. Again, for Russia, the oil price is an important consideration. I expect that oil prices will remain where they are or strengthen moderately. That's also a factor of importance for the Middle East and North Africa, where again I expect growth to be well sustained, if not up a little bit. And in sub-Saharan Africa as well, where we've had now, I think, 4 years of pretty good growth, especially in view of the global recession. I expect things to continue to do quite well, certainly by the standards of the past couple of decades. So emerging market and developing countries growing not quite as rapidly, but still quite solid performance, and I don't see much of a threat to that continuing through next year and into 2012. For the advanced economies, the story is not quite as positive and more mixed, and I'll return to individual countries a little bit in the discussion that I will undertake now. First, I want to turn to the United States and ask, well, what's been happening there? And with growth slower than my forecast, not the consensus forecast, slower than my forecast this year, why should we expect any acceleration next year? Well, the first column there lays out the main elements of the forecast that I made a year ago in terms of how much real GDP would rise and its components would rise over the 6 quarters to the end of this year. So I was predicting 6.5% growth over those 6 quarters, $838 billion of real dollars. We're going to come in short of that. We're less than half of it through 4 quarters, and I think by the end that the cumulative growth, 570, will be about 4.5%, so 2 percentage points below forecast. Now, why are we slower than expected? Well, consumption is the most important part of it, but consumption is slower partly because the savings rate has gone up a little bit faster than I anticipated, partly because maybe the stimulus package supplied a little bit less support to disposable income than I anticipated. Mainly it's because the other components of GDP didn't grow as fast, and so the income that supports consumption was not rising. The projection of 50% of gain of GDP being in consumption was a little too strong, but not badly off. Now, when we look at what fell short, there's a big negative number for net exports through the second quarter. That's because we had a huge surge of imports in the second quarter GDP data. I think that's a fluke, and that we're likely to see real imports probably decline in the third and fourth quarters. What's not a fluke is we did get the big boost from inventory investment. But as we look to 2011, that's behind us. We're not going to get much more out of the recovery of inventory investment over the next year. Business investment in structures has continued to decline. I think that will end by early next year, and we'll actually get a small gain in that component. Business investment in equipment and software has been doing extremely well and is on track to do better than forecast. And President Obama recently suggested that we put in 1 year of expensing, complete expensing, rather than extended depreciation. If that's in fact done, it's going to give a considerable kick in the rear end to investment spending late next year. So I'm anticipating we'll have another strong year in equipment and software investment. Residential investment is the key sector that has fallen short, certainly of my forecast. I'd have to say not of the forecast of others who are much more skeptical. But what I maintain is that we are now producing new households at a little over about 550, 600,000 units a year. That's barely enough to replace the units that are being removed from the housing stock by depreciation. When you add on top of that you need about 1.2 million units to account for net new household formation in a typical year, our new construction is well below what the sustainable rate is, somewhere between 1.5 and 1.8 million. Now, we're not going to get there all in 1 year, but the cumulative effect of recovering to that level, not to the peak in 2005, is going to add something like 3 percentage points, 3.5 percentage points to GDP. I'm projecting we're going to get about 0.5 percentage point of that in 2011, with more to come in the years following as the recovery gathers strength and the unemployment rate stabilizes and begins to come down. Meanwhile, I think net exports will deteriorate, but only modestly, and government spending, I'm not expecting big moves towards fiscal consolidation, either on the tax side or on the government spending side. So I expect government purchases to be a modest negative. So that's the story for the U.S., and to me it adds up to growth year over year of about 3.25%, and fourth quarter to fourth quarter with the boost that I think we'll get at the end on the investment spending of 3.5%. Turning next briefly to Europe, because Jacob is going to undertake this discussion in more detail, particularly on the policy side. My forecast for Western Europe in April was almost a percentage point above the consensus. We're not going to quite make it, but rather than 2, I think we're going to do 1.75 or 1.8. So I think the forecasts were too pessimistic, and they did not yet allow for the effect of the fiscal crisis that began to really intensify in April and May. And I think what we saw and are seeing is a tendency for the forecasters to be a little too pessimistic at this stage of the recovery. But there is no doubt that the fiscal consolidation moves that are underway on average across Europe are going to slow the pace of expansion relative to what we would normally expect given the depth of the recession in Western Europe. That, of course, varies considerably from country to country. For example, I'm not critical of the German fiscal consolidation efforts. It seems to me to be fairly modest and broadly appropriate. What the French are doing is not going to have much of a negative impact on aggregate demand in the short term, may even boost employment and output in the longer term. That's raising the retirement age for public sector workers, which is entirely appropriate to the extent they haven't already retired on the job. Obviously, the situation is much more serious in Greece, and I don't think the Greek crisis is behind us. We're going to come back to that next year. Jacob may talk a little bit more about that. Spain also, their growth is being slowed significantly by the fiscal consolidation, and there are a couple of others as well. So it's a kind of mixed story, but I think that the inherent strength of recovery will be strong enough to produce growth next year in Western Europe in the 2% range, maybe a little less, maybe a little more. Now, I'll take up Japan in the context of the discussion, relatively brief, of global rebalancing. The Japanese economy bounced back fairly strongly from the global recession, but it had the largest output decline in the recession of any G7 country. And so by the end of the first quarter of this year, when they'd had 3 pretty strong quarters of rebound, they were still 4 percentage points below the output level at the peak. Meanwhile, the Japanese yen, which hit a low point in May, June of 2007, had appreciated against the dollar and the euro by about 30% as of the end of 2009. And then over the summer, it appreciated about another 10 percentage points against the dollar and the euro. And the Japanese authorities became, I think, rightly concerned that this was going to undermine the recovery. I think we're seeing some of that already in the industrial production figures. And so Japan returned to intervention in the foreign exchange market to send a signal that, in their view at least, further substantial appreciation of the yen at this stage is unwanted and unwarranted. I think it's relatively easy to sympathize with the position of the Japanese authorities, having already seen a very large appreciation of the currency. Other countries didn't criticize the Japanese too strongly in public. They didn't endorse the Japanese action with coordinated intervention and support either. But I think that a reasonable view is that the Japanese have allowed the exchange rate to adjust substantially as it should in view of the fact that Japanese monetary policy is no longer by far the easiest stance of monetary policy anywhere in the world, and so it's reasonable to expect that the yen would appreciate, or the dollar and the euro would depreciate vis-a-vis the yen as we've gotten much greater equality of monetary policy instruments than has existed for many years. Now, China is another key element of the story. The situation in China is that their currency has appreciated moderately in real effective terms from 2004, 2005, but there's a general trend towards real appreciation in the equilibrium rate of 2 to 3% per year. So in contrast to Japan, where one really can't say too strongly the yen is extremely undervalued at present, in the case of China, there's a very strong case that the yen remains significantly undervalued. There's going to be disagreement as to how large that is, whether it's 15% or 20% or 30%, but that it remains substantially undervalued is not, I think, something that can reasonably be disputed. Certainly not here at the Institute, at the Peterson Institute, where we all basically agree, at least on this issue, if not on any other. Now, it's also the case that the Chinese current account surplus, which reached nearly 11% of GDP at the peak, has shrunk down to about 5% of GDP. Partly that's the adjustment that's occurred in the exchange rate, but also partly it's that the Japanese have adopted much more stimulative measures with respect to domestic demand growth. Now, I take the view, along with many of my colleagues, that the Chinese need to allow the renminbi to appreciate substantially over time vis-a-vis the dollar and other currencies. However, the objective in this regard is not primarily the exchange rate. Japanese current account surplus at 5% of GDP is big enough. If we're going to have a reasonably balanced global expansion, then we shouldn't see the magnitude of that surplus expand significantly, so long as margins of slack remain substantial in much of the rest of the world economy. That's a situation that's changed from 2006 and 2007, when the large Chinese surplus was occurring at a time when, in general around the world, resources were pretty fully employed. Now it can be argued correctly that the effort by the Chinese to enlarge their current account surplus would be a beggar thy neighbor policy and result with respect to the rest of the world. So whether they do it by allowing the exchange rate to appreciate more rapidly, which I think in the end will be necessary, or whether they do it by more effective means of stimulating domestic demand growth, what's critical is that we not see a return to the pattern that existed 6, 7, 8 years ago of persistent substantial increases in the magnitude of an already large Chinese current account surplus. Now, finally, for the United States, I've already discussed the forecast. As far as the imbalance is concerned, the U.S. payments imbalance, current account imbalance, has shrunk by about half, from a peak of 6 now to about 3% of GDP. President Obama, I was going to say President Carter, but I must be. President Obama has announced as an objective doubling U.S. exports within 5 years as a means of creating lots of new high-paying jobs. Well, that's fine up to a point. But what's associated with net job creation in the U.S. is not the expansion of exports. It's the expansion of net exports. Well and good for the United States to see, we want to see our exports expand strongly in the current global recovery, because as the U.S. economy expands, our imports will expand as well. And what we want to see is U.S. export growth that matches our import growth, which, if we get a reasonable recovery, will be quite strong. Imports generally grow about twice as fast as GDP. However, it would be unreasonable for the United States to suggest, well, we need everybody else to get out of the way and watch our imports explode and our net exports explode. Then we would be perpetrating a beggar thy neighbor policy on the rest of the world. So I think the U.S. needs to make clear when we talk about global rebalancing that global rebalancing applies to everyone, not just the Chinese, that in a circumstance where there's generally a lot of slack in many countries around the world, we need to see a pattern of recovery in which no single country is expanding its net export position at the expense of employment and output growth in the rest of the world.
Mike, thank you. Jake.
Thank you very much. I guess I should start by saying that I largely share Mike's relatively optimistic view on Europe, so I'm not actually going to have many quarrels with his short-term forecast, which is why, as he said, I'm going to concentrate more on the longer-term policy implications for what I term the European response to the current crisis. So coming back to the glasses, my glass on Europe is definitely more than half full. But the question, of course, first is that when this is essentially has been equated with the European crisis, which, of course, is this reemergence of bond spreads between the Eurozone members. But when you take the longer-term view, it is hard, for me at least, to not see that there is a certain return to the good old days, if you like. So the real question to me is whether we should view this as the entering into a crisis situation or really exiting in an anomaly or indeed a market failure. And I would probably say that that is a little bit of both. And as if you are like me, and as Fred said, I have write mostly of things like pension systems, structural reform issues. What this chart illustrates is in many ways actually very good news for Europe in many ways. I should also note that what this chart shows, which is bond spreads for several small European countries that share the same currency, is not something that should, in my opinion, meaningfully be used to draw implications for what bond yields are going to do for a country like the United States, and therefore European experiences are not much use when thinking about what the appropriate fiscal policies, for instance, for the United States is. But talking about the crisis scenario, again, the issue, as with I think with most economic crises, is that there's no real consensus on what the diagnosis is. I would say that I can at least discern at three relatively distinct schools of thought. The first one is those who will argue that actually it's because the European Monetary Union was in fact designed in a flawed manner and it was bound to experience the kinds of differences that we see today and ultimately in fact fail. The second school of thought, if you like, tend to focus on it as an external crisis or balance of payment crisis within the Eurozone, and then basically countries in the southern Eurozone no longer be able to financing their current account deficit. But more importantly, this kind of argument also places a significant blame on the surplus countries inside the Eurozone, namely first and foremost Germany. And then lastly, there's what I would call the more fiscal school of thought, which is really where I probably take most of my diagnosis of the crisis, which tends to view it as really a result of unsustainable fiscal policies and collapse of growth models, in particularly the periphery, which turned out to be not sustainable after the end of the real estate bubble. But it is clear that those who have different diagnoses of the crisis will obviously have perhaps a less positive view of the solutions that the European policymakers have brought about. But I thought before we getting into the substance of the response, it's worth talking a little bit about the process that we've seen play out over the last, or at least since early 2010. Because I think it's fair to say that this was a very, very ugly sausage in the making. In many ways, it was very amateurish, and you know, as I said, you can point a lot of fingers at individual policymakers and actors at particular points in time. But at the same time, I think it's important to keep in mind that, you know, the European Union as a policy-making entity has no experience dealing with a kind of real-time financial crisis that we saw unfold in late April and early May. This is, as I say here, it really is the first 2 a.m. in the morning moment for the EU. And there's no experience, so I don't think that there's anything. I think that both sides of the equation, so to speak, both policymakers and financial markets will have learned quite a lot from this messy process. Therefore, the next time it's going to happen, and I think it will happen again, I think the process will be significantly less messy. The second issue, of course, is that in the European Union, there is no Treasury Secretary at the end of the table to lay out policy. In fact, you've got a whole host of democratically elected heads of states whose opinions in a crisis solution process or a bailout, agreeing on a bailout, will in fact be opposed to each other in sort of a zero-sum game about who should pay. And it is totally natural that they will appear in the press to be not in agreement before they actually sit down and hammer out the agreement or the compromise, which is what happened in early May. So the short message here was that you will never have message discipline in the European Union. But one of the things that I really take to heart here is that all of the policy U-turns, and there were many, and I shall come to that later, in Europe during the crisis, were actually all in the right direction. You started in February with a very small number for the bailout package. You had no IMF involvement, and you ended up with a very big number. And actually full IMF conditionality, which is something that I regard as a very positive development. You also had a massive shift in the role of the ECB in this crisis. And even in the end, you also got, flawed as they were in many ways, but you did get increased transparency, at least from the stress tests. And then finally, of course, any bailout is subject to a lot of critique, just as TARP was in the United States, but ultimately, in hindsight, I think most people will agree that it actually did play quite a constructive role. But turning to the more substantive of the European response, and this is also outlined in the policy brief that you have in your folder, I basically call it a grand bargain. Because on the one hand, you have the ECB, which is, of course, a genuinely independent institution, which heads of state cannot tell what to do. It basically undergoes a tremendous and positive transformation in early May, where, and actually it started a little earlier in April, but it basically allows its balance sheet to be used and turning as a crisis stabilizing mechanism, and essentially, in my opinion, turns itself into a genuine lender of last resort for the Eurozone. And while it didn't, of course, do outright quantitative easing, I think it's fair to say that it moved very much beyond the traditional sort of Eurozone, Bundesbank legacy of only being focused on price stability, something that I think was very positive. And also the fact that it did so with dissent on the governing board suggests to me that even if you have a change of president of the ECB, this is not something that's going to change this new role that it has defined for itself. The other side of the bargain, so to speak, was what member states agreed to do. And I think, first of all, they'd agreed to do several things. First of all, they, of course, put up the money for these different bailout mechanisms. Which is essentially, they agreed to do what I call an ad hoc crisis-only Eurobond, which is essentially they open up the opportunity to have a fiscal transfer between states in the middle of a crisis. And I think that that's a very positive development as well. It's not nothing to do with a fiscal union, but in a crisis, in an emergency, this opportunity actually exists, which is very good for long-term stability. Secondly, of course, they agreed to do a lot of very dramatic and politically painful austerity measures, which for a lot of the southern European center-left parties, particularly in Spain, I would argue is sort of a Nixon goes to China moment, which really turned many of the southern European socialist parties into more traditional northern European social democratic parties, which essentially has a much more, shall we say, market-oriented and certainly in a longer-term sustainability sense, in my opinion, much more sensible fiscal outlook. And then they also agreed to do the strengthening of the Stability and Growth Pact that we just yesterday saw the proposals from the European Commission. So in essence, in summary, I'll sort of paraphrase Larry Summers on trade here, that the cyclically adjusted pragmatism in Europe actually proved much higher than what you would have expected before the crisis. And I think that that's really a very positive scenario going forward. Or you could also put it in another way, that the cyclically adjusted rigidities of the European economies, both in terms of structural reform and in terms of the policy positions of policymakers, actually were a lot more flexible than you would have expected pre-crisis. The question, of course, is who pays for all this? So what I did here, I tried to add up what the different versions or the different bailout vehicles actually end up costing in total. And it's very clear that if everything goes wrong in Europe, which I don't think it will ultimately be Germany and France that will foot the majority of the bill. And Also, as you can see, this is in billions of euros, and I just, for comparisons, I try to scale it to US GDP levels, and actually the scale of the European response is actually significantly beyond the scale of what TARP was in the United States. So I don't think that people should underestimate the political challenges of basically approving something that's significantly beyond TARP, but for other countries. And therefore, it's quite encouraging to me to see that both in Germany, ultimately, and in France, in fact, the vast majority of the national parliaments actually approved these measures. It was essentially a consensus both on the center-left and the center-right. And therefore, of course, these measures, they will, of course, introduce a very large amount of moral hazard, both political and certainly economic, into the European Union. And therefore, I don't think, given the scale of these potential political commitments, that it should be very surprising. In fact, it is indeed encouraging to me that a lot of the institutional response to the crisis has actually been aimed at limiting moral hazard going forward, because I think it's going to be very, very important if you want to maintain the opportunity for policymakers to basically authorize future bailouts, that you basically put in place significant restraints on these same member states in the form of reducing the opportunities for moral hazard, which of course is what the Stability and Growth Pact was really supposed to have done. Also, very quickly, and this comes back to the first chart, what we are seeing now and have seen in the last couple of months is what I regard as the new normal in the Eurozone, which is this, what we see, what the chart shows is bond market prices benchmarks, and it basically shows how in the last 2 months the three countries that have been in trouble are Portugal, Greece, and Ireland. But what it basically shows is that, contrary to the situation pre-Lehman Brothers, you now have, if you have deficient structural and economic policies inside the Eurozone, you are immediately faced with increased default premia in the financial markets. And I think, again, that that's a very, very positive situation for Europe going forward. And it also, of course, illustrates that what I would regard as the problematic periphery in Europe, at least right now, has in fact been reduced to just these three small countries. You've essentially gone from the sort of plural pigs countries to the singular pig country, if you like, or PIG at least. And that actually matters a lot, both in terms of scale, because it obviously means that none of these countries, in my opinion, pose a systemic threat to the Eurozone. And more importantly, it also means that a lot of the focus on the European crisis response tends to be concentrated on the big Eurozone special purpose vehicle, the so-called European Financial Stability Facility, is actually misguided. Because in my opinion, it'll never be used, because it doesn't need to be used for the smaller countries in question, because you actually have sufficient funds available for the other part of the European response, which is an extension or an expansion of the existing balance of payment system. The so-called European Financial Stability Mechanism, that you have about 100 billion euros available on that account, which I think would be quite sufficient. And also it has the advantage that because that is rooted in the European Treaty, it doesn't expire. And then I also wanted to talk a little bit about the longer term considerations, because there's a lot of analysis that really suggests that Europe needs to move to a fiscal, this comes back to the first of the crisis diagnosis, that Europe needs to go to a full fiscal union to ever have a credible monetary union. And I think that that's in many ways an argument that is sort of similar to suggesting that the United States has to eliminate its fiscal deficit by imposing a $5 a gallon gas tax. it's analytically appealing to the purist, and it has a lot of positive externalities, but in the real world, it's also pretty much a waste of time because it's never going to happen. And the reason I say that is that if you look at the chart on the left, what it basically shows is the self-identification of all the European member states' populations, which basically the red and the yellow colors here are those who either see themselves only as nationals or first and foremost as nationals, which of course runs in a sort of 80 to 90+%. And that matters because if you don't, there is no pan-European identity, and therefore the opportunity to expand the central budget of the European Union is going to be very limited. Because ultimately, like elsewhere, if you don't feel like it belongs to you, or you don't feel part of it as your identity, you're not going to be willing to be taxed by it either. So the willingness of Europeans to pay tax to the EU is probably even smaller than the general willingness of Americans to pay federal income tax. The second thing I think that it's important to keep in mind when you think about the broader dynamics of this crisis in the longer run is that it has meant a very substantial strengthening of the political weight, if you like, of Germany inside the European Union. The fact that all of the rest of the Eurozone no longer gets German interest rates essentially for free, that means that Germany stands much, much stronger in internal EU policy debate because essentially as the safe haven, peripheral countries can no longer, to the same degree as they could before, afford to escalate political disagreements with Germany because the perceptions in markets that Europe stands, Europe is not united, Europe is split, tends to now disproportionately affect the peripheral countries. And I think if you want to be really crude, if France ever were to lose its AAA rating, then I think it's fair to say that the end of parity within the European Union would also come from that, and Germany would clearly be the leading members. And then very quickly on this issue of populism, there's been a lot of talk in the about the rise of these right-wing populist parties in Europe. You saw it in the Netherlands, you saw it recently in Sweden, you've seen it across Eastern Europe, you've seen it in many places. And just yesterday there's a lot of demonstrations going on all over Europe. But actually this populism it is too easy to dismiss it as just right-wing extremism and anti-immigrant sentiment, because it actually it's slightly more complex than that, in my opinion, because what these parties do, the Freedom Party earlier, also in Austria, but in the Netherlands and in Sweden and elsewhere, if you look at them, they certainly have a lot of very, in my opinion, unsavory anti-immigrant rhetoric, traditional right-wing rhetoric, but they also have very targeted policy platforms that goes at actually promoting the kind of traditional welfareist policies, meaning low retirement, access to low retirement, unlimited unemployment benefits, et cetera, precisely the kinds of policies that the mainstream central left parties have actually been abandoning in the last 10 years or 20 years in Northern Europe, and that I would argue that the crisis has now forced parties in Southern Europe also to give up. So in fact, the populism that you see is in fact directly as a result of a growing economic consensus that is less concerned or less oriented toward welfare parties. So quickly to wrap it up, I think also on that note, so far at least, the Greek demonstration effect has actually turned out that austerity platforms has essentially won the last 3 elections in Europe. They won in the Netherlands, they won in Slovakia, and they won in Sweden as well. In fact, the only country in Europe where this mainstream center-left party has actively opposed measures towards more austerity is, amusingly enough, France, where the Socialist Party has come out very strongly against the 60 or the increase in the retirement age that Mike was talking about. And then there is these new European Commission proposals for reform of the Stability and Growth Pact. I don't have time to go into it in detail, but basically it's important, several things that are important. One, that I think these proposals are going to be pretty close to what we'll ultimately end up with. And then they focus on several things. I mean, but the big ones is that rather than just focus on the 3% deficit orientation, they also bring in and have a renewed focus on the absolute debt level, the 60% debt level from the stability or from the Maastricht Treaty. And then they introduce this reverse voting record, which basically means that sanctions will be applied unless a majority opposes it or votes against it. And that's important because basically it's quite easy to have a blocking minority under the European qualified majority voting. Basically, if you've got Germany, the Netherlands, and Poland opposed to or in favor of imposing sanctions on a country, it's more or less guaranteed to pass. So this is a significant step towards more bite in the sanctions. And then the other new thing that they put in is what they call the excessive imbalances procedure, which is very vaguely framed so far still, and it's clearly where a lot of the disagreements are still to be found, but at least it is there, and it is a mechanism that is supposed to be attacking the internal imbalances, Eurozone imbalances question, which was the second of the three crisis diagnoses. And it isn't in the same way as coercive as the sanctions, the up to 0.2% of GDP in fines in extreme, but nonetheless it is there. And I think the thing to keep in mind about it is that it actually is most likely to be applied in an asymmetric manner, which means that it's going to go after the deficit countries, not the surplus countries. I cannot imagine scenarios, because of the relative strengthening of Germany inside the EU as a result of the crisis, that the surplus country, Germany, will ever be exposed to sanctions in this way. And in some regards, what they will end up doing is that they will end up looking for bubbles in deficit countries, such as, for instance, the real estate bubbles in Spain and Ireland before the crisis. So in many ways, what this will amount to, in my opinion, is going to be sort of a functional equivalent of macroprudential regulation of the banking sector. It's essentially about identifying bubbles. Then, as I said, I think moral hazard is going to be, the attempt is going to be to try to control moral hazard as much as possible. Obviously, there's conditionality in the IMF program. That's one level. We have a more credible Stability and Growth Pact. That's another level. And then finally, I actually don't rule out the possibility for a sovereign debt restructuring mechanism inside the inside the Eurozone. And I think that if you're ever going to get Germany to approve of making it permanent, the 440 billion stability facility, this will be the price that they will demand. They will only agree to making it permanent or extending it beyond its current 3-year period if they in return get an SDRM on Eurozone debt. Then all of this means no country is going to quit the Eurozone, but I think it'll make it clear that other countries are not going to rush to join like they did in the late 1990s and obviously also with Greece in 2001. And I should perhaps just quickly mention that Greece, I think that it is most likely that they will have to restructure. That's still my central thesis. But I think the ultimately most likely outcome will be that they will get an extension they get a rollover from the official sector in 2011, 2012. And then the broader long-term challenge that the EU really faces is the end of convergence in the periphery. Because you're no longer going to have a positive story to tell for new members of the Eurozone and the EU itself, that you're going to converge towards the Eurozone average income levels. Instead, you're actually going to have a much more negative. You're not going to get the interest rate, the real interest rate benefits, and you're going to be subject to a lot more coercive restrictions from a more powerful or more forceful stability and growth pact. And yeah, ultimately, I'd wrap up. I just want to say very quickly at the end that this, the end of convergence in the periphery basically suggests that I think the ECB is going to be accommodating in its monetary policy for a very long time because of the very significant downside that the periphery faces from too rapid a tightening of monetary policy. And I think that was more than my allocated time. Thank you.
When I left the Federal Reserve Board and took up my position at Peterson last September, the first thing I did was to attend a conference at which I presented a paper calling for more monetary ease in the major advanced economies, that is the United States, the Euro area, Japan, and the United Kingdom. Parts of that paper were refined into a policy brief last December, and that has been included in your packets today, so you have a copy of that. I believe the policy recommendations I made then remain appropriate today, although I will argue for a modest twist in the specifics of how to accomplish them. I'm going to focus on the United States and to a lesser extent the Euro area. I think the case for monetary ease in Japan is so obvious that I won't waste your time on that. I think in the United Kingdom, our Peterson colleague Adam Posen, who's on the Monetary Policy Committee of the Bank of England, this week publicly announced his support for further ease in the United Kingdom, so I'll let him make that case. The current U.S. monetary policy stance, the key policy rate I believe now is the rate of interest on bank reserves, which is a 0.25%. The federal funds market, which was the old primary rate, is now quite small compared to bank reserves, and I suspect that will be true for a long time, so that the rate of return on reserves is really a better measure of the opportunity cost of lending for banks. But monetary policy is not completely described by these short-term rates. And in an attempt to deliver further monetary ease at the zero bound, by the way, the Fed has said that 0.25% is roughly the zero bound, close enough. So I'm going to consider that we are at the zero bound. In an attempt to deliver further monetary ease at the zero bound last year, the Fed purchased $1.7 trillion of long-term assets. In a paper that I wrote with staffers at the Federal Reserve Bank of New York earlier this year, we estimate that these purchases lowered the 10-year Treasury yield about 0.5 percentage point. Now, as an aside, I'd like to note that the Bank of Japan never engaged in this form of quantitative easing, despite some surface appearances to the contrary. If you actually look more carefully, what the Bank of Japan bought during its quantitative easing period was only very short-term assets that had yields already close to zero. So it actually never tried to push down longer-term yields the way the Federal Reserve and the Bank of England did. In normal times, it would take a reduction in the Fed funds rate or the interest on reserves rate of about 1 to 2 percentage points to get a reduction of the 10-year Treasury yield around 0.5%, so that one gauge of what the Fed has done through these non-conventional policies is to reduce the effective rate, the effective policy rate, interest on reserve rate, to something negative, like -0.75 to -1.75%. Okay, so how do we think about such a stance? In the original Taylor rule, the monetary policy interest rate equals an equilibrium real interest rate of 2%, plus the current rate of inflation, plus 0.5 times the deviation between current and target inflation, plus 0.5 times the gap between current and potential GDP. In the United States at present, the core inflation rate is 1%, which is about 1% below the target rate of 2%. The GDP gap, according to the Congressional Budget Office, is 5%. Plugging these values into the original Taylor rule yields a policy rate of 0. On this basis, U.S. monetary policy might be viewed as too loose, and indeed John Taylor has questioned the wisdom of purchasing these longer-term assets. However, since Taylor's rule was originally published, a number of studies have come out looking at what the optimal coefficients in the rule should be and what optimal forms of the rule might be. And they generally find that you'd want to have a larger coefficient, especially on the output gap. A former colleague, Glenn Rudebush, now at the Federal Reserve Bank of San Francisco, has proposed an alternative version of the Taylor rule that is estimated using the gap between current and equilibrium unemployment rates. His rule calls for an effective policy rate of minus 5.5%, and on this basis, U.S. monetary policy is quite a bit too tight. Now, a critique of these more aggressive policy rules is that we don't really observe the output gap very accurately in real time. We've made mistakes on that in the past, although at least we're much more willing now to understand the extent of our lack of certainty than we were before. And thus, this would argue that perhaps what you should do is apply a smaller coefficient, like the original Taylor coefficient, when the output gap is small, say less than about 2 percentage points, but apply a larger coefficient when the gap is large, when you're really sure you're far from potential. And since the output gap is clearly large at present, this would imply an effective policy rate much closer to minus 5.5 than to 0. Moreover, recent research suggests that the Taylor rule may not embody the optimal policy response, or Taylor type rules may not embody the optimal policy response to financial crises and their aftermaths. We know that, and some of the work of Carmen Reinhart and Ken Rogoff shows that after financial crises, recoveries tend to be especially slow. And the problem seems to be weak aggregate demand, not weak aggregate supply. Right now, everyone wants to deleverage immediately, and their attempt to do so is collapsing aggregate demand and income and then making it more difficult to achieve. Monetary and fiscal policies are ideally suited to address this kind of headwind. By lowering the rate of return to savers and the cost to borrowers, monetary policy slows down this deleveraging impetus and stretches it out so that it can occur at a pace that the economy can handle. Fiscal policy also helps by propping up demand and incomes directly while providing high-quality assets to those who want to save more. To illustrate the dangers of post-bubble macroeconomics, my next slide displays a chart taken from a speech by Governor Shirakawa of the Bank of Japan. In it, he shows the behavior of core inflation after the bubble burst in Japan, the red line, which is shown in the 1990s. And overlaid is the U.S. core inflation rate over the past 3 years, which is shown in blue. Governor Shirakawa raised the question of whether the United States might be heading towards deflation as Japan did. Now, some of you may think that it is silly to worry about deflation in the euro area or the United States. However, in a paper I wrote with about 13 co-authors at the Federal Reserve Board back in 2002, we showed that Japan's monetary response in the 1990s to the collapse of its bubble, after the collapse of its bubbles, was very much in line with the standard historical Taylor rule. But the Taylor rule did not prevent Japan from sinking into deflation. And I would add to those who point out that measures of inflation expectations in the United States and the euro area today are well anchored above 0, that measures of inflation expectations in Japan at the time also appeared to be well anchored above 0 until long after Japan fell into deflation. Now, another framework for thinking about monetary policy I'm going to call the Svensson Role, because Deputy Governor Lars Svensson of the Central Bank of Sweden has forcefully proposed this approach. In this approach, central banks set monetary policy to minimize GDP gaps and deviations of inflation from target well into the future. In practice, the lags in monetary policy mean that there's little that can be done about gaps and deviations in the next 3 or 4 quarters. And the inability to forecast over very many years means it's not practical to worry about gaps and deviations 5 or 10 years ahead. So the way this seems to work in practice, is, in particular as implemented in Sweden and the United Kingdom, is to set monetary policy to try to eliminate the gaps as much as possible 2 to 3 years ahead. So where does U.S. monetary policy stand in terms of the Svensson Role? First of all, I'd note according to the latest FOMC forecast in June 2010, and by the way, I would point out that it's not that different from Mike Moose's forecast, and I'm not basing my case on any disagreement with Mike on his growth forecast. By the end of 2012, the FOMC forecasts GDP gap based on projections of unemployment will be at least negative 2% or larger, depending on how you think about Okun's law, and that the deviation of core inflation from target will be minus 0.75%. In other words, the gaps and deviations will not be minimized after 2.5 years, and the errors are in the same direction. So there's no trade-off. There's no sense in which, well, we'll have to live with a bigger output gap because inflation is on the other side. Well, it's not. They're both errors in the same direction, so it compounds the problem. This presents a prima facie case that monetary policy is too tight. Turning to the euro area, we see that interest on reserves is the same as in the United States at 0.25%, but the ECB's main refinancing rate is 1%, and the interbank rate there is 0.4%, which is both somewhat higher than in the United States. Also, the ECB has not attempted to push down the yield curve through quantitative measures. Its relatively small bond purchases are aimed at specific market pressures, as Jacob said, and not broad macroeconomic conditions. So the effective policy rate is considerably higher in the euro area than in the United States. Now, where does Europe stand on the Svensson Rule? Well, getting forecasts of output gaps that far ahead in the euro area are pretty difficult. But the ECB has a survey of professional forecasters that recently projected that unemployment in the euro area will remain at 10% fairly steadily over the next 2 years. This is about 2 percentage points higher than what I think was a reasonable view of equilibrium unemployment in Europe of around 8% before the crisis. This suggests a GDP gap is at least minus 2% going forward over the next 2 years. The same survey shows that headline inflation will be 1.7% 2 years from now, which is only a tiny bit below the ECB's target. But the recent increases in some commodity prices and the recent hikes in value-added taxes, or VATs, have masked a steady downtrend in the euro area core inflation, excluding VAT, which I estimate to have been 0.6% on a 12-month basis in August. That's very low. Now, my ECB friends tell me that the history of Europe is that these core inflation rates tend to bounce back toward headline and not the other way around, which is what happens in the US. Now, I don't know enough about why that has been true in Europe in the past, but I think you certainly have to say there's more than a small risk that things could be different this time. The headline could go back down towards core, especially given the persistent high levels of economic slack in the euro area. Finally, it bears stressing that central banks should exclude VAT changes from the inflation measures they follow. Otherwise, they risk compounding the cyclical effects of fiscal policy. In other words, they would be tightening monetary policy whenever fiscal policy tightens and loosening monetary policy whenever fiscal policy loosens, which would be bad policy. So finally, let me just conclude with thoughts about what the FOMC should do. It's been talked about a lot lately. I think the most obvious option is to announce another large-scale purchase of long-term assets That has the virtue of following the precedent they set, and I think it's certainly better than doing nothing. In fact, it's what I recommended last year in the policy brief that you all have. But I think there are three concerns with this strategy. First, it's at least partly priced in already to the markets, so the impact effect on long-term yields might seem weak, and that might risk creating a market chatter or dynamic that the Fed is actually out of bullets, which would not be helpful. Second, such a large purchase cannot be conducted within the 6 weeks between FOMC meetings, so it implicitly commits policymakers well into the future. And third, buying assets with very long durations, like the 10-year Treasuries and 30-year MBS, creates a risk of future losses, a high risk of future losses on the Fed's balance sheet if and when interest rates have to rise. Second option that's gotten more attention lately is to announce a rate of purchase of long-term assets. For example, a rate of $100 billion a month would add up to $1.2 trillion over the course of a year, so it has the potential to be quite large. And yet it does not impose any commitment on the FOMC in future meetings. They can always change it. The downside is that this option has an even greater risk of seeming ineffective, at least initially, because it may be close to what markets are already expecting. And over time, the balance sheet risks, if this continues over time, are essentially the same as the large policy. So a third option toward which I've been leaning more lately is to go back to an idea proposed by a guy named Ben Bernanke back in 2002. Then Governor Bernanke said that his preferred approach to easing monetary policy at the zero bound would be to target the yields on near zero on Treasury securities that had short to medium maturities, and using aggressive purchases of these securities. So I suggest targeting the yield on the 4-year Treasury security at 25 basis points, which is a 75 basis point cut from its current level, and it would be a notable surprise to markets. It would demonstrate a significant effect. This approach does not impose any commitment on future FOMC actions. It's quite similar to the old approach of just setting the Fed funds rate. And by buying relatively shorter term assets, it might have less risk, pose less risk to the Fed's balance sheet. I would accompany this with a reduction of the rate of interest on reserves to zero, as I don't see any serious reason to continue to subsidize the banks by paying interest on reserves, which I never used to get anyway. And finally, if people wanted to add more stimulus and help the banks to deal with a flatter yield curve, I would recommend reopening the term auction facility and extending unlimited credit to banks at 25 basis points for terms up to 2 years, 24 months, provided that they have good collateral. And thank you very much.